heard that investing into the stock market is among the easiest yet best overall ways to build wealth over time and reach financial freedom, where you end up spending a ton of time looking for strong investments, building an optimal portfolio, and consistently investing into it over time, thinking that you're doing everything right, just to realize later that your investments actually grew much less than you thought they would. You see, the truth is, there are many simple mistakes that are literally costing you at least hundreds of thousands of dollars down the line, regardless of your income level. Literally, think of this like pouring water into a bucket that has a leak. Until you fix the leak first, no matter how much you add into it, it's not going to grow as much as it should. With that said, my name is Sully, and in this video, I'm going to explain exactly how hidden factors like taxes and fees are making your investments grow much slower than you think, and how fixing these leaks could significantly impact the overall speed and growth of your investments. And so to get straight to it, let's first go over the impact from taxes. What's really important to understand is that even if you don't sell your investments, or even if the investments decline in value, they can still trigger taxes to you, which has a large impact on your financial future, and that impact is called tax drag. And what's really important to understand is that there are two main factors that contribute to this. The first is capital gains distributions, and the second is income distributions. When it comes to capital gains, that is how much you trigger in taxes when an investment you own is sold for a gain. And depending on how long you hold the investment before you sell, the taxes are going to be treated as either short-term or long-term capital gains, where short-term capital gains are taxed in the same bracket as your ordinary income, which would be triggered if you were to sell an investment within 1 year of owning it. Where long-term capital gains occur after selling an investment that you own for at least a full year, and the gains here are treated with better rates that are 0, 15, or 20%, based on what bracket you're in. Now, if you properly plan things out with your investments, investing in a normal taxable account can actually be extremely beneficial, even when it comes to tax purposes. But it could also be a huge nightmare because there are certain investments that you may not be aware of that are actually causing taxes to be triggered even without you knowing. In fact, a study I came across showed how the average large cap mutual fund has a total annual tax cost of 1.79% that is strictly from capital gains and income distributions. All that means is that on a $100,000 investment, you would have almost $1,800 lost due to taxes in 1 year, which doesn't even include the expense ratio that I'll cover more on in the next section. Which, by the way, if you don't know what a mutual fund is, it's pretty much a simple way to invest into hundreds to thousands of different types of investments that are either picked by professional fund managers, which means it's actively managed, or it would track a particular stock market index, meaning that it is passively managed. But what's really crazy to see is that if you had $500,000 invested for 20 years, averaging 7.5% per year, the difference from a 2% tax drag could make the difference of $665,000. Or say you're just starting off from zero and you contribute $600 per month into a super tax efficient portfolio. If you average the stock market return and do this for your entire career, your end balance could be roughly $3.3 million. But with a 2% tax drag, that would make the end balance $1.9 million, which is a total difference of $1.4 million throughout your career, all because you weren't aware of the more tax-efficient alternatives that have a huge impact on your future. Now, what's really important to be aware of here is the tax drag from capital gains distributions, especially with mutual funds, because these could occur even when you don't touch the investments. This is because mutual funds are structured in a way where anytime the fund changes the underlying holdings, the ones that are sold could trigger capital gains, and those gains would be distributed to you if you owned the fund. In fact, Vanguard recently had a huge $106 million target date fund settlement because their mutual funds triggered significant taxes to investors, and the ones that held them in normal taxable brokerage accounts were hit with a big tax bill out of nowhere. That's exactly why I avoid owning mutual funds in taxable accounts, especially the ones with high turnover rates. On top of that, I found it funny that this article said, I would hate to be the advisor that has to explain to a client why they owe so much tax when they didn't even sell their shares. Now, if you want to see the history of the capital gains triggered from a mutual fund, I found Morningstar to be a helpful resource where you can see for the mutual fund FMEGX, you can see the exact amount of short and long-term capital gains gains that were triggered to all the investors previously. Where if you look at the ETF FMEG, there are no capital gains triggered to investors that didn't touch the fund. To avoid this from being super long or even confusing, if you want a deeper scope with examples on this, I'll have another video that I created in full detail linked in the description below. Now, if you already own a tax-efficient index mutual fund like the S&P 500, an example could be FXAIX through Fidelity, to me, if you have significant gains, by no means do I think it's worth selling and triggering the taxes for. But if you have the choice going forward, based off of the data, I like to stick with ETFs. Now, the next area to also improve the growth on your investments is to reduce the tax drag you have from income distributions. All this means is that you want to reduce investments that trigger any sort of dividends or income, because all that's going to do is trigger more taxes. Please understand that this entirely depends on your situation and what you're looking for, but if you are young, looking to maximize the growth on your investments over time, this is really important to know. As you can see in this image, some of the best investments for taxable accounts include large cap and total market index funds, small cap, mid cap, or value index funds, where ones you'd want to avoid are bonds, REITs, and many other high income producing investments. You see, the income from bonds are taxed at ordinary income rates, as well as the majority of REITs, which are real estate investment trust companies, and many dividend funds, especially the high income producing ones, also trigger non-qualified dividends that are also taxed as ordinary income. Now, there are ways to become more efficient with dividend investments, like one of my favorites, that is the dividend ETF SCHD, that yields a very strong dividend, and this fund is noted to have 100% qualified dividends if you hold it long enough, which means they are taxed as long-term capital gains in the 0, 15, or 20% bracket. But to give you an example and exaggerate the importance on the difference here, I'm going to compare two options: a popular high income producing ETF, that is JPI, that's yielded roughly 8.3% of income over the previous year, when compared to a popular growth fund that is SCHG that yielded just 0.4% of income from dividends. And let's just say that you had $100,000 in each. That means after 1 year, JPI would have paid $8,300 to you in dividends. And don't forget, whether you reinvest your dividends or not, the income will be taxed. Where on the other hand, with SCHG, you would have triggered $400 from dividend payments. Not just is that significantly lower, but SCHG's dividends are also 100% qualified, which means if you hold it long enough, they would be triggered as long-term capital gains, where because JPI is a high income producing fund that uses options to generate a lot of the income, there may only be 20% in qualified dividends, where the rest could be triggered as non-qualified dividends. To keep things simple, let's say that you are single, in a state with no income tax, and have a $75,000 salary. That means with the dividends from JPI, you would have to pay roughly $250 from qualified dividends, and then almost $1,500 from the non-qualified dividends, making that an exact total paid in taxes of $1,710, which is a 1.71% tax rate solely due to dividends on your $100,000 investment. And even crazier, the fund also has a 0.35% annual fee added on top of that, making the total annual drag for this investment, based on this example, 2.06%. In fact, since JPI was created in 2020, it has averaged an 11.85% annual return. For looking at the potential after-tax returns, Fidelity factors in the numbers based on being in the highest federal tax bracket, but with that, you may end up averaging 8% per year after tax. And if you took the dividends as income instead of reinvesting them back into the fund, your portfolio could have actually declined in value even after all the years of investing into it. Where with a growth-oriented fund like SCHG, from the example, a $400 dividend income triggered, holding long to be qualified dividends would make you pay only $60 in taxes due to the dividends, which is a 0.06% tax drag on a $100,000 investment. And not just that, but the fund only has a 0.04% expense ratio, making the total drag over time for this investment 0.1%. And with SCHG being tailored for growth, the average returns for SCHG over the past 10 years, it was 14.94%. And even if you were in the highest tax bracket, your after-tax returns would still average to be 14.67% per year. Now let's just say that you did this over the past 10 years with $100,000. That means that you would now have an amazing $393,000. The main point I want to get across here is that the dividends from JPI could easily bring your investments down 2% per year when compared to a strong US index fund that would barely have any tax drag. So whether you're using the wrong mutual funds in the wrong accounts that could carry additional capital gains distributions, or high income producing investments that could trigger a significant tax burden to you, every year that you invest into either of these, just understand that it will cost you now and even more later on. Now, before I briefly touch on fees, if you are finding value in this content, all I ask is that you consider hitting the like and subscribe button for future content like this. Knowing that, let's now go over the fees to know about when investing. Now, just like tax reg, fees that come from the investments you choose or management services you use, they can also have a significant impact on your future wealth. And you really want to make sure that you don't have both high tax reg and high fees, because your investments will 100% grow much slower than you think. So to sum up the main fees that you need to be aware of, some of these may not even apply to you, but the first is if you are using a robo-advisor to automatically handle your investments. NerdWallet states that may have an additional 1/4 to 0.5% annual fee, but it is at least much better than the traditional financial advisor that is a 1 to 2% fee per year. I will say many financial advisors are really locking in on the tax efficient investing side of things, but if you have a poor financial advisor and high tax reg, rather than averaging what you should at around 10% per year, you may very well end up averaging 6 to 7%, and that doesn't even factor in inflation. But as far as fees to be aware of when investing on your own, really be on the lookout for what's called the expense ratio. This is the total cost it takes to own the fund per year, and it's automatically going to be factored into your investments over time. It's not something that you have to pay separately. But let's say that you want to invest into an actively managed fund that you were told could easily outbeat the market significantly, and so you decide to look into the ETF ARK by Cathie Wood. Well, the expense ratio here is 0.75% when compared to a simple S&P 500 index fund like VOO that has a 0.03% expense ratio. To break that down, that means on a $100,000 investment, ARK would cost you $750 per year, or the S&P 500 would cost you $30. At this point, I don't even think I need to show calculations to explain why the simple index fund is the better choice long term. But I will mention index funds like the S&P 500 have historically proven to be among the most superior long-term investments, where it's actually very rare to find actively managed funds that outbeat the S&P 500 after all factors considered, and especially over a long period of time. So to summarize everything mentioned in this video, to reduce the leaks on your investments and optimally improve the overall speed and growth, this is what I at least do and highly recommend. Rather than buying mutual funds in taxable accounts, especially the high turnover ones, I believe it's much better overall to just stick with ETFs. I also believe it's best to then aim for index ETFs that track strong markets, and then from there to also aim for the lowest expense ratio ETFs, then the lowest dividend paying ETFs. And if you are one that likes the idea to live off of dividends before retirement with a taxable account, I would really aim for those that pay qualified dividends. Aside from that, I would aim to hold your investments for at least 1 year. And if you are looking at foreign investments, keep an eye out for any additional taxes that may apply. And the last thing I'll mention is that before the year ends, you may also want to consider tax loss harvesting, which means you may want to sell some of your losing investments that you don't want anymore, because that could offset some of your tax burden. All in all, tax reg and other investment fees may very well cause your investments to grow much slower than you think. And if you did find value in this video, consider sharing it with someone that you think could greatly benefit from it. I'll also mention that I've created many learning guides, such as how to build an investment portfolio or my index fund cheat sheet, that I think you could find great value from, which I'll have a direct link to check these out in the description below. On top of that, if you want to start investing on a new platform or check out other top financial products, I'll have direct links below as well for you to learn more, which depending on the ones you choose, I may earn a commission for it, which is greatly appreciated. And I will say, if you want to see exactly how I allocate each of my investments and other exclusive content, to consider checking out my Patreon linked below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.